All right, I start recording. Yep.
All right, welcome everyone to the Accounting Design Project Workshop Series. My name is Robert Rainey. I'm an assistant professor at ESA Business School in Barcelona. Today, we are very excited to welcome Alina Lerman from UConn to present her co-authored paper, Impairments of Investment Securities by Non-Financial Firms. Before we get started, a few housekeeping items. We encourage everyone to turn on their video cameras, but please remember to stay muted unless you are asking a question. To ask a question, please virtually raise your hand. Both Alina and I will be monitoring for that. If you prefer, I will also be monitoring the chat. You're welcome to type your question there, and I will relay it on to Alina. Let's give Alina 5 minutes of uninterrupted time at the start. And with that, Alina, the floor is yours.
Thanks, Robert. Thank you, everyone, for taking the time. I know this is the end of the semester, so people are busy, and we have lots of, I think, a lot of the conferences are happening right now with the different schools. So thank you for taking the time. So yes, this is co-authored work with Kalin Kolev, who is giving an exam today. So he has a valid excuse not to be here, and also with Tara, who is with us and will be noting all of your questions and suggestions. So thank you for that. Okay, so just a little bit of a background. If I hope I'm not the only one in admitting it, but I have a zombie drawer of projects. Those are the projects which are not quite dead, and hopefully will become reanimated at some point, but sometimes they are kind of in limbo there. So this project, Kalin and I started it an embarrassingly long time ago, let's just say a long time ago. And really it started as a little bit of it started with an anecdotal observation, and then we wrote a really small version of it that's really focused on the financial crisis period. And I think we presented it once, and we're just about thinking about where to take it next. And then we were in the reality of the new guidance going into effect, the guidance I'm going to talk about, the ASU 2016-01, which really made us question whether there is any room for us to continue the project, talking about a rule or application of the rule, which on a large piece of investments is no longer in effect. So we weren't sure if it's worthwhile to do it. So we put it in a drawer and we let it die for several years. And then it is now a reanimated zombie, because we came back to it and we thought, well, we still think it's an important topic. I think we understand, we know as researchers very little about the overall kind of investment behavior of non-financial firms. We focus on impairments. I'll talk about the guidance and the background in just a second. It's something that we still don't have really any understanding for, again, on our sample. So we think it's important. And we think with the new rule, it's actually also maybe particularly important to understand whether the change is maybe justified for the sample that we have in question. So we reanimated. So now this is effectively a new project. This is really in its new form. This is only the second or third time that we are presenting it. So we are actively considering the direction and also the positioning which to take right now. So this is a perfect opportunity for us. Any and all questions, both today and if anything that you want to follow up with us, if it comes to you later, would be really, really welcome. Okay. So let me talk a little bit about the motivation. So we have a set of robust papers on the various dynamics on financial instruments accounting, but those papers focus on financial institutions. And when I say financial institutions, I mean both banks, investment vehicles, and insurance companies. And by the way, I apologize if you guys can hear any pets, specifically dogs, cats, and parakeets. Right now I hear the third very loudly, but hopefully they don't come across. But I live in a zoo, so somebody might interrupt me, so apologies. So again, most of the things that we know about the application of accounting rules with respect to financial instruments is in the setting of financial institutions. And as I'll talk about the new guidance on the accounting for financial instruments, it really, if we look at the regulators' approach, they also adopted this omnibus approach that we are going to look at the things which are a problem primarily in the financial institutions, but we're going to apply a new guidance to all industries, to everyone. It should be applicable kind of indistinguishably. And it's not clear to us that that's necessarily the optimal approach in this particular setting of the financial accounting rules. So we have non-financial firms, and by non-financial firms, again, this is kind of excluding banks, trading companies, and insurance firms who do hold significant investments of both equity and various debt securities. And inherently, the reasons why they hold these positions tend to be somewhat different than the reasons why financial institutions have their portfolios. So the application kind of accounting rules and the evaluation of how those portfolios are doing might be different for non-financial institutions as compared to financial institutions. We do know how companies evaluate their productive assets, and we have a lot of research how companies evaluate their productive assets, tangible assets, goodwill, intangible assets. But again, the nature of these financial portfolios for non-financial institutions make the thinking about the value of these assets very different. These are orthogonal to maybe the way that you think about your firm's performance, which is really significant for the productive assets that you are considering, what their value is and whether they've declined in value and whether you need to reevaluate your carrying of them on the financial statements. So again, kind of this setting where you have non-financial firms hold portfolios of financial assets differentiates itself both from the financial firms and what we know about firms, how they treat their other assets, the productive assets. So we think it's important, at the very least, to kind of understand how these firms were applying the rules of accounting for these types of assets. And if anyone wants to jump in the questions, we don't need to give me more time than that. So feel free to jump in at any point here. Okay. Let me talk a little bit. I have 2 slides on accounting again, kind of if you're not heavy in the accounting for financial instruments, you might not have all of the background. So let me just give a little bit of a brief review of how we account for financial instruments. So before 2018, the guiding rule was ASFAS 115, which has been in place since 1993, and that really accounted for majority of the equity and debt securities. And that was that rule specified the different buckets of trading securities, held to maturity, available for sale securities. And there's a number of interpretive guidance. I have some of it listed here that kind of specified how to evaluate the decline in the various types of these securities. There's actually even more guidance that was promulgated and then repealed a year later. So it was quite a bit of a contentious topic in terms of what is the appropriate evaluation, whether the volatility in the value of these securities, needs to be reflected on the balance sheet. Does it not? Needs to be reflected in the income statement. Does it not, etc. So it was a little bit of a back and forth. So for available for sale securities, which could be equity or debt securities, and held to maturity securities, which could only be the debt securities, you have to evaluate something called other than temporary impairments. And that's the term that we stick to because that's the official language of that guidance, OTTI. And that term, other than temporary impairment, is really limited to the accounting for these types of securities, which made our data collection actually a little bit easier. So the OTTI is when the decline in the value of the security is flown through and recognized on the income statement instead of just being reflected in the other comprehensive income portion of the balance sheet, or not reflected at all in the case of held to maturity securities that are not marked to value. Now, when would you actually apply other than temporary impairment? It's when you do have a decline in value So you actually are observing that you have this in your portfolio, and where you make the determination that this decline is not going to reverse in some horizon which is suitable for you. This is where kind of one of those situations where regulators really were doing a little bit of wordsmithing, and you actually have one example of interpretive guidance that says other than temporary is not the same thing as permanent, because they were trying to get at firms saying, well, you can't just say this thing will recover at some point. Most things, maybe recover at some point, but you need to think about whether it will recover in a time period where that's going to benefit you, where you have the ability to wait for that recovery given your specific characteristics as a firm and the characteristics of this investment. Okay, and everyone kind of agreed that the determination whether a decline in value should be reflected as an impairment on the income statement has a fair degree of judgment in it. It's not a very bright line rule. It does require managerial judgment. Ayun, go ahead.
Alina, I remember like after the Great Recession, the 2008-2009, the OTTI has kind of like these two subcategories. One is based on more external factors. The other one is more proprietary. Does that kind of relates to your research question?
Yes, so that's the last interpretive guidance here that I have listed here, the one that was promulgated in 2009, the 115.2 and related 124.2. So that said that specifically for debt securities. So it applied to debt securities, and it says when you have a debt security, you're allowed to essentially bifurcate it and think about whether the decline in the security is systematic, something that has to do with macroeconomic factors, and of the nature that we expect them to be seasonal to some degree. So this is kind of, the underlying assumption is that these macroeconomic factors are more likely to be reversible. And those things have an out. You're allowed not to flow them through the income statement. Versus if this is something that's more to do with the nature of the security itself rather than the macroeconomic. So again, that was only applicable to debt securities. We delved into it a little bit, but we actually don't have that many situations that we observe for these firms where they say, yes, this is a debt security, and the decline is attributable to something that's systematic, so we're not going to flow it through. So this is something that we see a lot for financial institutions, this very big debt portfolios, very kind of sensitive to various type of influences on the value of those securities. Not as much something that we found to be relevant for our firms.
Thank you.
Okay, so that was what we're going to call the old guidance. Okay. The old guidance was questioned, and this is where kind of the timing here is a little bit uncertain in terms of the FASB sometimes does take a long time in terms of proposing a significant change, but then dialing it back because of the feedback received, or modifying it, or shelving it altogether. And we have a little bit of this happening here. The first draft of what is now the guidance ASU 2016-01, which said we really need to fundamentally kind of change how we account for financial instruments. It's a kind of a big scope project. It was introduced in 2010, so it was fairly long time ago that it was put forward. It contained more things than just the aspect that we are focusing on, which is kind of the available for sale and held to maturity securities. It has implications for things that eventually become CECL, etc. But it was, so again, it was kind of a big scope project. It received a tremendous amount. It received 3,000 comments, which I think is one of the biggest amount of comments that FASB has received in terms of their pronouncements. They took a significant time to kind of revise and change some aspects of the proposal. The second draft came out in 2013, and then the final draft came out in 2016 and went into effect in January of 2018. So post 2018 is what we have the new regime. Now, what's the difference between the old and the new regime as it relates to our question? Is that effectively it's eliminating the available for sale category. So the equity securities, now you don't have the process where you look at the decline, which is reflected on your balance sheet value, and you make the determination whether it is temporary or other than temporary, and that guides kind of where that decline flows through. Instead, you automatically apply the fair value accounting kind of methodology where you say, okay, any decline in these securities will flow through to the income statement. So the concept of other than temporary impairments for equity securities has gone away with the new guidance. It still exists for debt securities. The debt securities, some of the accounting for debt securities did change as well, and we don't really get into it in the paper, but there are certain aspects of impairment evaluations which are different for debt securities, but the pre and post regulation change is not nearly as dramatic for them. It's really the equity securities that's a big change, and also the one where the firms that are of interest to us, the non-financial firms, were really sensitive to this change coming about and what that's going to, how they feel about it. And I'm going to show you some of their comments on the next slide, and what the implication for them will be. And one of the things that's worth noting is that this is even, from the FASB proposal itself, in terms of what type of firms gave a big stimulus to the promulgation of this guidance versus what type of firms it's applied to. We have the board saying that, the issues that gave rise to the consideration of this proposal were raised in the context of financial institutions that, for example, the discretion in terms of evaluation, whether a decline in value is temporary or other than temporary, and whether that discretion is used not judiciously, those were issues contained to the financial institution setting. However, the board believes that the proposed guidance should be applicable to all industries. So this is not a guidance for financial institutions. This is going into effect for everyone in the US GAAP setting. Okay, so how did non-financial firms feel about this guidance? And again, I'll talk about our research, which is focused on the pre-regime, but it was, in some sense, we are kind of motivated by this feedback in terms of what the firms were saying about the proposal to eliminate for equity securities the available for sale treatment and the determination whether the decline should be remaining on the balance sheet or flown through in the income statement. Yes, I have a question.
Hi, Alina. I just, after having a look at these blurbs in your appendix, I just had a suggestion for you. So I think broadly, the paper could start with orienting the readers around what is the sort of determinants of an AFS decision. These blurbs say that it's a strategic decision, and I recall from my experience in financial instruments that they are usually there's a transition between AFS and then either they become an equity method style investment or increase into some serious investment over a very long period of time in which the market is being assessed and things like that. So I think that type of qualitative understanding of what type of firms engage in these and what sort of investment potential they gain, this would help position the paper a bit better in terms of introducing first the AFS as a choice category. And related to that, I also wanted to say that I think there are papers that look at OCI components. So in the pre-period when OCI is moving and being erratic or whatever, if that is being systematically priced for the AFS, there's cash flow hedging going on, etc. Not that or currency translation, but singling out the AFS, if the disclosures allow, would also give sort of a pre-understanding of how investors have been conceiving those movements in absolute terms as they relate to the OCI for AFS.
Okay, thank you. Yeah, I hope we pick up. I know there's definitely several of the papers that that helped us to set up the market tests, which are focused on the OCI, and a couple of them actually specifically single out that the non-financial firms have a different dynamic than the financial firms, but I'll check that we're not missing any that speak to the unrealized gains and losses specifically, because that's the part that we're interested in. And you actually raised a very good question, and this is something that I'm gonna come back to the audience a little bit when I get to the sample, in terms of we do exclude one big group of non-financial firms, which are pharmaceutical and tech firms, which are the type of firms where the small holdings very commonly lead to the big holdings. For those firms specifically, very often you have the path that you suggested, where I kind of start with dipping my toe in the water and doing an available for sale holdings of equity, with the intention that this is going to translate to a bigger significant influence holding, which makes a determination of horizons and kind of all expectations a little bit different for those firms. So for now, we excluded them because it was partially because of data collection, and kind of we expect them to have a little bit of a different dynamics. Our intuition is that outside of those industries, majority of these holdings do not turn into equity method. It's very hard to track because the disclosure, investment by investment level disclosure, is very shoddy before you get to the equity method. So
I was just intrigued by the mention of the word strategic in many of these blurbs, and all of them. So I just wanted to know, what does that mean? Maybe a determinants of an AFS, yes, no, would show that, oh, very high BMI ratio, BM ratio, or what are they doing that is driving the AFS behavior in some way or the other. This article is really good in terms of penning down some of the ground realities of the movements that you're also, they do some univariate analysis you might find useful.
no, that's a great point, and I think that's something that we are missing in our determinant test. I'll talk about, we talk about the determinant as they relate kind of to the regulation, but I don't think we have any variable that really captures the likelihood of a strategic positioning of the investment. And I think we can think about because I think it's missing. Yeah, that's a great feedback. Ayun?
Yeah, so like I think related to your last point, I was thinking about the M&A literature, usually using some very coarse industry classification to identify strategic mergers versus kind of speculative, right? But it really depends on whether you are able to see the holding composition of what firms they actually are invested, or what kind of the firms they actually hold shares. But I think your last comment mentioned that it's actually harder, but more difficult for you to actually identify the underlying invested firms. If you are able to see the portfolio, that what are the other firms Google is invested or Pfizer is, right? You can classify those holdings into within some industry memberships will be strategic, and outside of the same industry. A pharmaceutical firms investing in an industrial chemical company will be classified as speculative, and that will give you a very coarse way, but has been using the M&A literature for a long time to identify strategic holding versus speculative.
Yeah, I think no, you are 100% right. If we could do that, I think we would go down the route. So let me just give a little bit of the reality in terms of what the disclosure looks like, right? So for the disclosures that we're looking at, again, for kind of non-financial firms, so very often you do not see anything beyond the table that will show you, public debt, private debt, public equity, private equity, level 1, 2, 3. So if you kind of envision this, 4x3 table, and that's where it stops. Now, if something becomes impaired, in the impairment, they will give you more detail in terms of, oh, we have this charge and it is due to this particular. Sometimes they will give a name of the company. Sometimes they will say, oftentimes they will, even in that situation, they will not. This is, one of the reasons why this research is done on something like insurance companies, where it is really portfolio holding by holding, beautiful data. We see a huge diversity in practice in terms of what non-financial firms were disclosing. That remains right now. So for example, for debt securities, right now, even for equity securities in terms of volatility flowing through, but kind of looking at their holdings, not only can't, so that there's dual difficulties here. You cannot identify most of the time their specific holdings line by line. And also, if you think about, for example, on the income statement, you cannot identify a lot of the time, if there's an impact on the income statement, what percentage of that is coming from a realized gain or loss with the securities, some securities being sold and other pieces coming from unrealized. They're bundling it together. They're really not disclosing, which is also part of the reason why we actually, to be honest, let this project sit in a drawer, is because you're working with data which is not granular enough to answer a lot of what you want. Is that a fatal flaw or not? That's our kind of question and concern right now. But I do think that we can maybe, going back, so both of you kind of raised this point, we could at least proxy in terms of the overall tendency of a certain firm to behave in strategic investment setting, and saying those are much more likely where they are, because that is certainly consistent with this language. And then try to get at that indirectly if we can't get at that directly. Yes. So overall, I won't read all of these comments, but overall, the non-financial firms were essentially saying the old model worked just fine. The fact that you are subjecting us to the new model is not consistent with how we hold securities. We don't do them as a trading portfolio. And the other than temporary impairment model was actually effective and was working well. So we don't like it that there's now introduction of this volatility to our income statement. So our research question can really be summarized as, did the old model in fact work just fine? So that's what the comments say. So we'd like to get a sense of whether that seems to be true. There is a tension in the old model where you do have flexibility in your decision to recognize other than temporary impairment. Any flexibility we know can be used opportunistically or strategically. So however, it also gives the valuable information content in terms of the decline in value being or not being permanent. So which one seems to be the more likely case for these non-financial firms. So we're going to, the paper provides some descriptive evidence just in terms of how often do we see these impairments and what type of securities appear to be impaired under the old guidance. And then we jump into our determinants test that says, we're going to try to see which is the dominant factor, the things which are aligned with the rules, which is you're more likely to take an impairment when you're more likely to experience an impaired investment and you don't have intent and ability to hold, or do we have evidence of strategic reporting? Ayun?
So Alina, when I read the paper, I kind of still confused about your research question. So that when you say work just fine, to whom? Like who is actually the potential users of this OTTI, and then what information attributes you want to capture in terms of relatively better off or worse off for that targeted user. So do you have anything?
Right, so that's a great point, and that reminds me of James's presentation 2 weeks ago, right? Yeah. So we're kind of in the question of we need to be careful in our the concept of compliance and the concept of informativeness are not necessarily synonyms. And as researchers, we kind of, what is it that we are going after? And I think, the determinant analysis that we makes up most of the bulk of our paper is about compliance, right? So it is, it works just fine in a sense that the rules specify that you are supposed to make a determination of an impairment in a certain way. You observe whether or not there is a decline, and then you decide whether that decline is something that you can ride out or not, given your horizon of your specific firm. does that seem to be what was actually how the rules were applied? So that is a compliance question. That is not an informativeness question. That is just, we had rules and maybe the rules were stupid, right? That's that doesn't help us answer that. But under the old rules, do we have evidence that they were this flexibility was applied somehow to the firm's advantage, which is what spurred the new guidance, is that the flexibility was misapplied. Do we have evidence of that, or do we have a stronger evidence that the firms were appearing to be in compliance with the thinking of how you need to determine if there's an impairment? In terms of informativeness, we get at that a little bit. We say, okay, who should it be informative to? Let's suppose that it should be informative to the equity shareholders of this firm, because that impairments gives you some indication that maybe some portfolio holdings are not going to be translated to the cash flow. So there's liquidity implications that you were expecting the firm to be in a better liquidity position, and now you're evaluating that for their future capex needs, et cetera, et cetera. Or perhaps you expected these to translate to to realize benefits when you sell these securities or something else, or to equity method investments or other good things, and the impairment gives you a signal that that's not the case. So we get at that. We do one market response test trying to get at that second component, which is the informativeness. But I think the bulk of it is just the compliance, which is that, and is, I guess what you're saying is that that doesn't come clearly in the paper. So we need to think about off the bat how we position that.
So I think the compliance piece relates to my first question about whether it's caused by systematic factors, which likely to be observable to entities outside of the examined firm versus firm-specific or instrument-specific factors, which usually researchers as outsiders do not really observe, right? So to examine compliance, you somehow need to come up with a benchmark. So 2 weeks ago, James' paper is that somehow use market book, right? Or the observable benchmark to researchers to evaluate whether there are some incidents where the firm should have reported recognizing impairments but have not. But like, I don't know whether you are able to identify, to verify using some external benchmark to actually evaluate what type of the securities should be impaired but not comply with the rules, so not reported by the managers.
Yeah, so I think in the ideal setting, we'd be able to track the unrealized loss that any firm that has an unrealized loss, whether that loss essentially goes away in the future and how quickly it goes away before they are liquidating the security. I think that would answer that directly, and we are not able to do that because of the non-granular reporting on both the balance sheet and the income statement and the footnotes. So one thing that's not in paper we try to do at some point is we try to track the kind of whether impaired securities are subsequently sold at a gain, whether there's kind of a little bit of that, and it was very difficult to it was impossible to separate portfolio components. But I hear your point, and again, I think it's about the informativeness is would the stakeholders looking at this be able to make their own determination in terms of, well, everything is down, so of course it's temporary, we don't care, right? Versus not. And I'll think about that. So I think that's something that's a fair point. James.
Alina, you brought up a really interesting point about the footnotes, and I was wondering if you saw changes in disclosure in the footnotes over time. So if it seems like a company's should have an impairment, but they're claiming it's temporary, is this something that they bring up or explain in the footnotes? Or is this something that is kind of completely hidden from investors and other users of the financial statements?
No, it's pretty bad and it stays pretty bad. So but I think, so there's some examples that so a lot of the times when in this situation, and again, I think it's a little bit of the materiality as compared to, for example, goodwill, but if we did the work internally and we have determined that the decline is temporary, we're not going to go into details. We might give this to the auditors to explain why this is, but we're not going to make this very public most of the time. There are some exceptions, particularly for like auction rate securities, because this was very kind of tight timeline in terms of when they declined, and everyone is questioning. I do have a firm, some examples of a firm, one quarter saying, yes, it declined. We think this is a fluke, it will rebound. And then a quarter later saying, yeah, it wasn't a fluke. So now we're flowing this through. But it's not, frankly, I did not find any systematic patterns where, for either firms that did not impair or that impaired, the disclosure shows some, some progress. So
Appreciate the clarification.
yes, let me go ahead.
Just a little bit more context. I think, I don't know if you want to look at this or not, but in the classic financial sector, the AFS, when it's debt driven, for example, and now especially when the interest rates are causing asset values to decline, we see that there is some importance to hedging that movement. And on the AFS front, there is a lot of accounting hedges that try to circumvent the fair valuing. And I think that will be even more important when 2016-1 comes in. And then you have that fair value in the income statement. That's the whole point. They're saying income volatility is artificial. We want to get rid of it. So something that you can think of is, do they increase their use of derivatives just to manage this volatility, because it will go in the other direction, and equity instruments have those derivatives in the market. This is something that I can vouch, but just a thought, just in terms of whether you would.
Yeah, that's a great point. Our intuition is that these are not the firms that are as heavily relying on this as some of the more financial institutions, et cetera. And certainly they have hedges, but oftentimes it's for a different reason. It's the hedges that are a little bit more specific to to offset the inputs, volatility, things like that. But you bring me to kind of the last point, something that we just dabble in, and again, it's not really a real convincing test because the data sucks, frankly. But we think that what's happening is a little bit more in line with their claims in the comment letters, that rather than hedge it, what we're going to do is we're going to step away entirely. So if you are forcing us to do this for equity, frankly, we're going to hold less equity. So, and again, it's not a very strong test because of our data limitations. It's just kind of some univariate statistics, but we think that and we certainly anecdotally, we see some firms doing that, is closing their equity portfolios and not dealing with these effects. So not 100% sure, but there are some. So we do know. So I think there's I miscited in the paper. We say there are 3 insurance focused papers. There's actually 4 insurance focused papers that look at that question in terms of the implication of this on the portfolio holdings. But yeah, we didn't really think too much about derivatives, and I think we can at least capture on the high level whether these folks do or don't engage in them a little. Okay, let me jump. So let me jump a little bit forward just because in the interest of time. So this is not our data. So let me start by saying this is originally what we started with this project in. So this is a little bit of dirty data because this is not hand collecting. This is us just running through and seeing references to other than temporary impairment in the same paragraph as some quantities as opposed to just policy discussion. So this would need to be hand collected to actually verify it. But this when we did this originally and we focused on the financial crisis, we noticed that almost surprising to us, we do have a fair number of non-financial firms. Obviously financial firms, more than half of them are taking impairments during this period, but even non-financial firms seem to be fairly, I guess, more frequently than I would have expected, saying, okay, we have this significant things which are impacting our portfolio, we're going to take other than temporary impairment. Now, as I mentioned, actually, we need to hand collect things. So our subsequent focus of the paper ended up being on these industrial non-financial firms. So we're excluding financial, but as I talked about before, we're also excluding tech and pharmaceuticals, which are also more frequent than others in terms of recognition of impairment. And partly it's because we didn't quite know how to deal with the strategic aspect of the holding. Firms very rarely tell you explicitly that something that's not yet equity method is gearing up to be equity method. But I think if our readers essentially tell us that without looking at that industry, we're not getting a complete picture, that's also something we've been talking about, whether we need to consider what the dynamics in the tech and R&D heavy industries was happening, because they're the ones with actually the biggest portfolios outside of the financial firms. Now, our actual sample is the one that's clean and hand collecting. So we focused on SAP 1500, we focused on these non-financial industries, and we manually checked every reference to other than temporary impairment, whether the firm is actually reporting other than temporary impairment, and then as much information as we can gather in terms of what is the underlying security, any details about what it is that they're actually impairment. So the sample itself is not very large. So we have 125 unique firms. We have 352 instances of impairments during this 2000 to 2013 period. So we are, and that kind of fairly confident saying that's because of the usage of that term other than temporary, we're probably picking up close to 100% of the actual impairments that were disclosed in this period. But it is fairly significant in terms of if we look at just the firms in these industries, we have, it differs industry by industry, but something like 10 and 20% of all the firms will disclose an impairment at least once in our sample. So this is something that the firms so the firms were evaluating their portfolios, they did apply this rule. So obviously the spike of the impairments went up dramatically during the financial crisis, but we do have the impairments both before and after the financial crisis. They're a little bit, there's a little bit of a kind of pronounced drop off. So, and I think the financial crisis also brought increased attention to it. So kind of they continue to be higher than at the pre-period. All of our tests we did just in the financial crisis, overall sample, non-financial crisis. So I think what we're picking up are kind of consistent dynamics over time. There doesn't seem to be anything that the firms were profoundly doing different during those 2 years. We see the impairments across the fiscal quarters. They are lumped more in the fourth fiscal quarter. And this is an interesting observation, because just like Eddie Riddle's dissertation back in the day pointed out that the things that focused in the fourth quarter, despite there be for these types of assets, the rule doesn't say that things need to be evaluated at least annually. It's really more of a, did the decline occur, evaluated for impairment, but the fourth quarter still seems to be loading, presumably because of the greater process of information kind of collection and more thoughtful accounting processing of information at that time, and the interaction with the auditors perhaps as well. Okay, in terms of how big are these impairments? So in the median, they're not very large. So most of the debt impairments, our median is $2 million, equity impairments $5 million. There is a number of impairments that we can't identify. They literally do not give us enough information to tell what it was that was impaired. Again, $2 million, which I think if you think about this as compared to the asset base of these companies, it doesn't appear to be very impressive. It's not very large. If we think of this as a percentage of the pre-impairment income that they were reporting in the same quarter on their financial statements, on the income statement, then it's a little bit bigger. In the mean 18%, in the median 3%. So it's not an insignificant, it's not an immaterial experience for the firm to recognize the impairment. And we thought it was pretty interesting just to, again, to kind of document, because like I said, a lot of the times when you look at the portfolio while they're holding it, when everything is going well, you don't really see what it is comprised of. It's when they have an impairment that they give you a little bit more information, what it is that they impaired. And we can tell a little bit more about that. It's really a lot of things. It's private equity and debt, it's public equity and debt. Most of the time, the impairments are not portfolio wide. Almost, majority of our impairments, where they explicitly said it's really on these one or two securities, one or two security types that we experienced an impairment with, which is consistent with kind of the idea that their portfolios are not extremely diverse and heterogeneous. They tend to be much more selective in their portfolios than the financial institutions, which are much more diverse. So jumping to our kind of main test. So again, how do we contrast? Oh, James, go ahead.
Oh, just a quick question. So for the few times that they kind of do disclose exactly who's getting impaired, it might be interesting to track whether a firm is simply following what kind of the other company is doing. Is the other company impairing themselves, and these non-financial firms just take that as a quick signal, or are they really kind of thinking about it more long-term and holistically? I think it just might be interesting to look at that for a few subsets of. I admit you'd have a big sample to hand collect here, but it might be interesting to.
No, yeah, I think so. I think again, most of the time when they are impairing something like so when you're impairing a debt security, that firm or whatever that instrument, either whether it's a firm's instrument or municipality or something else, is really not doing well. So this is, they're probably past the point of evaluating their assets for impairment, and they are really, we have concerns that the cash flows are not going to happen within our holdings. For the equity securities, it's not maybe as pronounced, but again, if I think about what it would take for the stock price decline to be that significant for me to kind of trigger this, I would guess that those firms are also a little bit past the point of should we or should we not, impair our own stuff. There's probably kind of a delay there. But I'm not sure. This is. Okay, so we try to come up with factors which should capture the recognition of impairment as the rules prescribe you, that you are, you have an intent and ability to hold something that has declined in value, as opposed to the factors that should capture opportunistic or strategic impairment. And we do primarily logit, we do kind of the linear probability model as well. So we do a bunch of robustness tests. But let me kind of go through the basic findings. And we have the reason why we have two different samples in our tables is because the variables that we think should be one of the variables that should be particularly important in explaining an impairment are the variables that capture the amount of unrealized losses, and those are available in Compustat only for from 2006 forward. So let me focus on just kind of one of our columns, because I think they all give similar tenor. And we try to look at the variables that capture the likelihood that your portfolio experienced a decline. So something that the firm would have realized and reflected in their balance sheet if they have available for sale security, or at least just realized if they have hold to maturity securities, even if it's not reflected in the balance sheet. And we see most things that are rational in terms of when the firm would have an impairment. It's when you do have bigger portfolios, when you have size as the number of employees in your firm, when you have presumably a better accounting department that's more able to get this information in appropriate time, when you have a fourth quarter, when your portfolio experiences a decline, even on the things that you're not impairing. So what we see is that the impairment takes place in the quarters where other items in your portfolio also are in decline. So this is unrealized, the adjusted unrealized loss is the unrealized loss captured in your OCI in a given quarter after you strip out the recycling of the impairment into the income statement. And also when you had unrealized losses in your portfolio in the prior quarter. So again, which is consistent that if you have these unrealized losses, they're more likely to translate to the need to impair. We have a little bit of puzzling results, we think, we try to capture whether you have an intent and ability to hold these securities until they recover. And what we see is kind of as expected, if you are more active in trading in terms of on your statement of cash flows, you have the sales and purchases of securities, which make up a bigger portion of all of your investing activity. Then it's more difficult for you to argue that you're going to hold it until recovery. So those companies are more likely to, in fact, impair if they're more active traders. If you have a prior impairment, that also suggests that you're probably of the type that's less likely to hold it with the intent and ability. The part where we have a little bit of puzzle, we would expect that when your liquidity pressures are higher, if you expect that you will need this cash before you're able to hold it to recovery, then we should expect higher probabilities of impairment. So current ratio, free cash flow, we expected those to be negatively associated with the impairment. We do not see that. We actually see them positively associated. And frankly, we're a little puzzled because I think this goes back to some of the questions. Perhaps we don't understand the full dynamics, and I'll talk about our selection model a little bit as well. Robert, yeah.
So did you look at like quick ratio? I know my experience has been that maybe that provides a little bit cleaner measure of that, like short-term or near-term shortfall in liquidity.
Yes,
and also, you did, okay, and nothing. And also the effect
same thing.
not,
it's exactly the same thing, yeah.
The effect also might not be linear, so you could have liquidity need where you're looking at an indicator where your quick ratio is below 1, for example, suggesting there's that shortfall. Also, I thought you could look at Witted and Wu. I think it was either 2006 or 2008 have a financial constraint proxy where you could try to look at more of a broader picture of alternative sources of liquidity to meet those short-term needs.
Yeah, those are great. Yeah, we haven't. I think you're absolutely right. Is that it? Because on the upside, we get into, and I'm jumping ahead, but there's a little bit of a selection issue that the more liquidity you have, the bigger portfolios you have, the more likely you are to invest, and maybe that's what's here. We try to get at that selection model, but I don't think we do a job. Versus, I think you're pointing out exactly right. It's healthy firm versus very healthy firm is not what should show up here. It's the unhealthy firm that perhaps say, okay, we don't have this. So that's something that we could easily do. Yeah, thank you. Christina. Oh, you're muted.
A potentially, related variable could be the cash conversion cycle. Okay, I think, and then, the other, issue that comes to mind is the literature on the cash reserves, why companies retain cash reserves. I think this literature may give you some insight. I mean, for example, tech companies may wish to, to retain lots of cash reserves because, actually their cash conversion cycle is very slow, I assume here. And that recipe, really accelerate the use of these instruments. There could be a dynamic like that. Just a few ideas.
That's a great point. We'll try the cash conversion cycle. I don't think we've done that, but if you actually raised a great point, and I'll sacrifice a minute of my time for the sake of PhD students to because I think this is a good opportunity. So something that I mentioned is one of our robustness things that we do is we do a selection model. We say, okay, we're going to try to first do as a first stage predictive model is what makes a non-financial company more likely to have a financial portfolio, okay? And we do it 2 ways. What makes you likely to have at least a non-zero financial portfolio, and then what makes you likely to have a above median financial portfolio. And we're going off of the literature that you mentioned. We look at the papers that say we have some, primarily in finance journals, we have some papers that look at what determines cash holdings of the firm. And what those papers typically do is that they lump together cash and financial instruments, highly liquid financial instruments, and they say, well, if you have high growth opportunities, if you have limited access to capital markets, they come up with some factors which predict the level of those cash plus investment holdings. Okay, so we take those models and we apply them to just investment holdings. Okay, so controlling for cash to just investment holdings. And so for our purposes, first of all, when we do this, and then we do that as a first step, and then we throw in the inverse Mills ratio as a second step, we don't see any changes in our findings, so controlling for the selection. But the thing that kind of, that the reason I want to bring it up to the students and to all of you as well, is that those models overall are not doing a good job. Like that first level, first step regression, I think our R squared is like 8%, 9%. So overall, we're not doing a very good job of identifying the factors that make non-financial firm hold financial portfolios or hold high levels of financial portfolios. And I think that would be something that would actually be important and interesting to think about it and to identify. And it just jumped out at us that when we just apply these models, which were shown for all liquid assets, we're not quite getting at that decision tree. So we're continuing to try to think about it, but again, it's kind of a secondary to us. But we think it's we think it's important to understand as well. But the final thing I want to highlight here, and again, it's kind of the punchline of our paper, is that we have some models that try to capture whether you appear to take an impairment when things are particularly bad, consistent with big bad, when things are better than for most, consistent with kind of smoothing, at the same time where you have other negative special items, kind of highlighting that other negative special items are mostly related to your own performance. Any positive relationship between OTTI and things like goodwill impairment and your productive assets impairment should not exist if you're just applying the rules, because they have to do with your performance versus the performance of another entity, not even necessarily in the same industry. And we don't see any of these kind of relationships suggesting a strategic or opportunistic reporting, not seem to be loading in particularly quarters. People don't avoid them in the quarters where they just meet the analyst expectations, things like that. So we do this for all firms. So these are our sample of firms with OTTI and all other non-financial firms with non-zero investments in at least some years. So those have a potential to evaluate for impairments. We separate debt and equity, and again, kind of see mostly similar dynamics. So I know I'm almost out of time, so I'll skip that. We do this just for OTTI firms, saying, okay, maybe OTTI firms are just different. So do they seem to be strategic in terms of picking which quarters to recognize? Do they delay their impairment recognition to the quarters that maybe are more fortuitous? And again, we don't seem to see that. So kind of overall, the pulse check is that we think that these firms are in compliance with the rules the way that they were written under the old regime in terms of evaluating the decline with your intent and ability to hold. So we follow that up with saying, okay, well, look at the market response. So we're limited here because only half of our sample disclose OTTI in the earnings announcement window. The others are in the periodic report, so we don't do the same short-term return analysis on that. But here we see this interesting dynamic is that if we regress the abnormal 3-day returns on the forecast arrow, as well as on the magnitude of the OTTI. So this is reflecting not just the incidence of OTTI, but the magnitude of OTTI. What we see is that there is a reaction from the equity shareholders, and it differs across the debt and equity OTTI. So for the debt OTTI, we see a negative reaction. For the equity OTTI, we see a positive reaction. We have some potential ideas why that may be. I'm going to stay after because I know I'm out of time. Happy to chat about people, but it's a little bit of a puzzle here. But certainly the market does seem to price that which to me seems that that's the answer to the informativeness in addition to compliance question. Lastly, I won't get into this because like I said, the data is really tough. We do see some anecdotal and some very preliminary univariate evidence that non-financial firms have unraveled their equity portfolios afterwards. For really a lot more detailed work on this issue, I suggest that you guys look at the 4 papers that look at insurance firms. Although the last time I looked at them, I think there's a little bit of disagreement. So I think it's an interesting setting where what's really happening here. So I am out of time. I will say there's a lot of uncertainty for us at this point. Which way do we push this paper? Do we go to equity method as well? Do we go to the R&D firms as well? Or do we stick with this sample and really think kind of, you know, some more opportunities to speak to the informativeness and the compliance? And just in terms of positioning this as a kind of, you know, evaluation of the rules. So really any feedback would be very helpful offline as well as today. Now, lastly, I want to make sure that I point out that we do have another seminar next week. Matthew Settergren from Santa Clara University, same time, same place. He will be speaking, do node disclosures influence value relevance more after financial statement placement becomes more uniformly prominent? And he's speaking about another guidance adoption, the ASU 2011-05. Okay, so I will stay after if anyone is available to chat some more.